So we'll be looking at the topic cost of capital just as a revision. As a revision. Now, when we talk about cost of capital, I want to break these two words, yes, so that you will not just know it as a topic, but you will know it in a practical term as it ought to be. Yes, beyond just saying cost of capital as a topic. What's cost of capital? What is cost of capital? When we talk about cost, cost is the sacrifice that you have to give up to get something. And when you talk about capital, capital is what you need to establish a business, to establish a business. Now, when you marry these two words together, cost of capital can be viewed in two ways. To you giving out the capital and to the person that is receiving the capital, there is a cost. There is a cost. So the person giving out the capital to an entrepreneur to set up a business, the cost of the capital will be the reward, the benefit he or she will get, the interest he or she will get. Now, to the person collecting the capital, the entrepreneur, the costs of the capital to that person will be the interest the person will pay on the capital. When returning the capital, what will be the additional interest on that capital? So that will be the cost. So cost of capital represents the compensation required by the suppliers of funds from their investments. You that you are supplying the fund, what is the compensation you are expecting? You that you are getting the fund, what will be the cost of that capital to you? And the cost of that capital back on the loan you obtain to set up a business. So in cost of capital, we can say it is the rate of return that the suppliers of capital, and who are the suppliers of capital? The bondholders, the shareholders, those that have enough to give, they are the suppliers of capital. So the rate of return that these suppliers of capital require as compensation for their contribution of capital is referred to as cost of capital. So in some other parlance, it can be referred to as the minimum rate of return a company must earn in order to retain its value. So one thing with the issue of cost of capital and its importance to firm is that a firm creates value when it provides a return greater than its cost of capital. What do I mean by a return? For example, you are a shareholder in Dangote and the dividend you are getting is higher than what you've invested in Dangote. It means you want to speak more of Dangote to your friends that come and invest in Dangote because the dividend is worthwhile. So you as a shareholder, you are helping Dangote, you are financing Dangote by giving out your fund to Dangote to use for investment. So the return you get as a shareholder is what is dividend. And that dividend to you is your own cost of capital because you're giving out your money as a form of investment to Dangote. So that return you will get, which is dividend, is a cost of capital to you. So Dangote, the cost of paying you dividend is a cost to Dangote, is a cost to Dangote, but to you is a compensation, is a compensation. So the cost of capital is determined by the forces of market and it represents the degree of passive risk by investors. So in cost of capital, we can look at the issue of cost of equity, and look at the issue of cost of debt. We can look at the issue of what cost of redeemable debt. We can look at the issue of cost of irredeemable debt. We can look at the issue of cost of preference shares, and also all these forms of cost of capital we've talked about. So I'll go back to them once we are through with the subject matter that I want to discuss per se. Now, the main point of this class is to look at the issue of project-specific cost of capital. Project-specific cost of capital. Project-specific cost of capital. When we talk about project-specific cost of capital, let's assume you are into a business. You sell cold drinks. You sell cold drinks. Now, you discover an opportunity in hot drinks. Yes, I'm using cold drink as an industry, hot drink as an industry. You discover an opportunity in hot drink. Now, you are already in a business in the cold drink industry. But the fact that you discover an opportunity in the hot drink industry, you want to diversify from cold drinks to what? To hot drinks. Now, you have your own capital structure in the cold drinks, which is fine. But now, you want to venture into the hot drink industry that you don't know what is happening there. What will you do? You don't have an idea of what is happening there. You need to look for a company, a business that have been in operation in the hot drink industry. A business that have been in operation in the hot drink industry, and see what is the business risk they are facing. What is the business risk they are facing? And how will you determine their business risk? You have to determine their business risk by looking at what we call the asset beta. The asset beta. The asset beta. The asset beta measures the business risk. But in the question might not give you the asset beta. They might likely give you what? The equity beta. The equity beta. So before I move further, I'll quickly give an explanation of each of these concepts. So when a business and a financial risks of a company are expected to change significantly, when the business risks and financial risks of a company are expected to change significantly, or where the company is diversifying into another industry, the company will need to appraise new investment opportunity with an appropriate cost of capital. So this appropriate cost of capital means they need to determine their WACC, their weighted average cost of capital. So when we talk about business risk is a risk that is associated with the industry in which a company operates. Business risk, the fact that you are into the cold drink industry and you have company A, B, C, D, E, F in that cold drink industry, each of these companies will face business risks, will face the same business risk, because they're in the same line of business. But these companies might not face the same financial risk. They might not face the same financial risk because their capital structure can vary. What do you mean by capital structure? Some companies are solely financed by equity. Some are financed with equity and debt, while some can solely be financed with debt. So when you have debt and equity, it means your financial risks will be different from a business which is solely financed by what? By debt. So financial risks of companies varies. They vary. But business risks of business in the same line of business, we always do the same. To diversify. You want to diversify. You need to get a model, a company, a business as a model in that new venture you want to diversify into. So you use that new business, that existing business in that industry as a proxy. That proxy is going to form the basis of your comparison. So when we talk about proxy company is a company that has similar business risks with the main company, that has similar business risks with the main company. So it is assumed that the business risks within the equity beta of these comparable companies is similar to the business risks of the new project that the company is considering. So the grammar might be too much, but when I begin to solve a question, you see what I'm trying to refer to. So when we talk about beta, let me cut the story short. When we talk about beta, anytime you hear beta, beta is a measure of risk. Beta is a measure of risk. That is BETA, is a measure of risk. And there are basically two types of beta. Basically, two types of beta. We have the asset beta and we have the equity beta. We have asset beta and equity beta. When we talk about the asset beta is used to measure the risk associated with the industry in which a company operates. So the asset beta measures what? The business risk. Take note, please. It measures what? The business risk. That is the asset beta. So asset beta measures only business systematic risk. So let me ask a question now. Let me ask a question. We have let's assume we have two companies, company A, B, C. Two companies, company A and B. Let's cite an example to make this clear. Company A, two companies A and B, A and B. Now, company A operates in the agricultural sector. Company A operates in the agricultural sector, but wants to diversify to mining. Or want to diversify to mining. You can have it this way. Company A, you are in agriculture, the agriculture sector. Agriculture. Company B is in mining, the mining sector. Now, company A, but they are seeing prospects in company B. They want to diversify into the sector of mining. Now, what company A will be interested in to know about company B will be what? Will be the business risk being faced by what? By company B. And this business risk is termed as what? The business risk is termed
Asset beta.
asset beta. It's termed as asset beta. So by the time you are given a question, and the question is stating that company A has been in agricultural sector for a while, but there is need for diversification to the mining sector. What company A will be interested in will be to evaluate if I should diversify to mining sector, what are the business risks associated with mining? What are the business risks associated with mining? That will be what company A will be interested in. So the question might not give you this business risk free of charge. They might not give it to you directly. So what do you need to do? The question might give you the equity beta geared. They'll give you the equity beta geared. Equity beta geared. Equity beta means the beta consists of both financial and what? And business risk. Please take note, equity beta shows that the business contains the assets, contains the what? The business risk and the shows that the business contains the business risk, and what? The financial risk. So equity beta consists of what? Business risk and financial risk. So when you are given a question, the company that you want to evaluate their business risk, take note, you'll be given their equity beta. So what are you going to do? The equity beta consists of what? Debt and equity. Debt and equity. So what will you do? Since you are only interested in business risk, you will do what we call, you will ungear. You are ungearing to remove what? The financial risk. Because what you are interested in is just the business risk. So once you ungear to remove the financial risk, you can now use the business risk into your own model. You incorporate the business risk into your own model, into your own capital structure, and see what will be the appropriate cost of capital to use. And see what will be the appropriate cost of capital to use. So asset beta is used to measure the risk associated with the industry in which a company operates. So asset beta, I said, measures only business risk. So business risk is also known as operating risk. It's also known as operating risk, and it is the risk associated with the company's operating cash flows, such as sales, variable cost, scrap value, initial outlay, and so on and so forth. Now, we have equity beta. Equity beta, as I've said, that is a measure of business and financial risk. Equity beta is a measure of business and financial risk. It is usually greater than the asset beta. Now, when we say equity beta measures business and financial risk, and I'm now saying that it is usually greater than the asset beta. Why is it greater than the asset beta? Why is it greater than the asset beta? The reason is, okay, right on.
Because asset beta is also embedded in the equity beta.
Yes. So asset beta is also embedded in the equity beta, and asset beta is only measuring what? The business risk.
Business leave.
Why equity beta is measuring what? Business and financial risk. So when you combine financial risk and business risk, it will definitely be greater than the asset beta. The asset beta. So the point now is, how do you solve questions on project-specific cost of capital? How do you solve questions on project-specific cost of capital? There are various formulas, but one thing I will assure you that no matter the formula you are using, you will still arrive at the same result. You still arrive at the same result. So if you are used to a particular formula before, fine. As I present the formulas again today, if it is different from what I put down before, never mind. When we solve and substitute into those various formulas, you always get the same result. You get the same result. So now, for you to solve questions on project-specific cost of capital, we have some steps. We have the following step. I'll write them again. Yes, I will not use my existing slide, because I want everybody to write and get it again. So I will not use what I have before. I'll just do a new write-up. I'll do a new write-up so that everybody will follow as expected. Now, steps involved. Steps involved in calculating project specific cost of capital. Now, how will you know a question is project specific cost of capital? That is one thing we must analyze. How will you know that this question is talking about project specific cost of capital? How will you know? Because the examiner will not tell you. So Can I get a response? How will you know?
The moment you are getting
Moment you are
in,
getting
hello, sir.
in and also
I can hear you now.
Hello, sir. The moment you are seeing issue of diversification from
Very good.
a particular sector to another sector, then you should know there is a project specific cost of capital.
Yes, that is just it.
Just
Once,
I was thinking, sorry, sir. What if when you have a parent company, I have a proxy too?
yes, the proxy is also telling you that this is a project specific cost of capital, because the proxy is your basis of what comparison, is your model that okay, this is what I'm to use. You are using your proxy. You need your proxy to know what the business risks in your proxy. Yes. So your proxy is what you are diversifying into. So the first steps to solve question on project specific cost of capital, number one is for you to identify what the beta, identify the beta, identify the beta. What kind of beta are you identifying here? The equity beta. You identify the equity beta. The equity beta. You identify the equity beta. The equity beta. The equity beta of what? Of a proxy. Of a proxy. What do we mean by proxy? That business you want to diversify into. The company you are using as a benchmark is the proxy. Of a proxy in the what? In the new industry. In the new industry that you want to diversify into. In the new industry that you want to diversify into. So once you identify the equity beta, there is something you must note. You ask yourself, is the equity beta geared or ungeared? Is the equity beta geared or ungeared? So where the equity beta is geared, what will you do? You ungear. You ungear. Now, what do I mean by gear? Gear means the proxy company is being financed by what? Debt. Debt. When you hear geared, some authors will say levered. Levered. When it is a company is geared, it means they are also being financed by what? Debt. Debt. So as you identify the proxy company, you are not interested in their debt. You are not interested in their financial risk. What are you interested in? You are interested in what? Their business risk. In their business risk. So what do? You ungear. You remove that financial risk and have only what? Your business risk. Because your business risk, the business risk is what you need. So once you identify the proxy company in the new industry, what do? You confirm. You confirm. You confirm whether it is what? Whether it is geared or ungeared. Whether it is geared or ungeared. So the question is, a geared beta, a geared beta is an equity beta, is an equity beta that incorporates what? That incorporates
Financial.
that incorporate both business and what? Financial risk. Both business and financial risk. So an ungeared beta, an ungeared beta measures only what? When it is not geared, it measures only what?
Business risk.
Only the business risk. Only business risk. Only business risk. Only business risk. So if it only measures only business risk, it means that an ungeared beta is also what? If it only measures only business risk, it means an ungeared beta.
Asset beta.
Asset beta.
Very good. Very good. An ungeared beta. Ungeared beta is an asset beta. Is an asset beta because there is no element of debt in it. It's an asset beta. So now, once you identify your proxy company and there is element of debt, there is element of debt, what will you do? You ungear. You ungear. When you ungear, it means that you are removing what? The debt element in your proxy beta just to get only the business risk. So ungear. So if proxy beta is geared, if proxy beta is geared, so ungear if proxy beta is geared to remove what? To remove the financial risk. To remove the financial risk. To remove the financial risk. So this is the English. You can see ungear, comma. It means if you identify the beta of the proxy company and there is debt, what will you do? The next step is for you to ungear, comma. And I'm emphasizing this comma so that when you are reading, you will know that ungear, comma, if proxy beta is geared to remove what? The financial risk. So that the reading will make meaning to remove the financial risk. So how do you remove the financial risk? We can use different forms of formula. We can use different forms of formula to remove the financial risk. So to remove the financial risk, this can be calculated using debt equity proportion of the proxy company. The debt equity proportion of the proxy company. What do you mean by debt equity proportion? It means if you have your capital structure to consist of debt and equity, and you have equity to be what? To be 200,000 naira. You have debt to be 300,000 naira. Now, what is the proportion? Your total capital is what? Total capital is what?
It's 500,000.
500,000. So what is the proportion of equity to the overall capital?
2 divided by 500,000.
Yes, 200 divided by 500. You have the proportion of equity to the overall capital. 300 divided by 500. You have the proportion of debt to the overall capital. So now you use that concept. So what is the formula we need to take note of? For you to get your business risk, we'll have our formula this way. I'm going to rewrite it again. I will show it in two forms. Whichever formula you adopt, you are going to get same result. So once you identify the proxy beta, you ungear the proxy beta using the proxy company's information. Take note, using the proxy company's information. So the formula will be asset beta equal to equity beta geared. This formula is always in the question paper, but there is no crime if you know it for the period of these exams. Yes, for the period of these exams, you can know it because as you solve questions, it will definitely be part of you. So we can have it this way. Equity beta geared divide by equity beta geared so there is a bracket multiply by equity divide by what? Proportion of equity plus what? Plus debt. Debt is always enjoying tax savings. So anytime you see debt, it will be net of tax. So 1 minus what? 1 minus t. 1 minus t. Then you do what? You close your bracket. You close your bracket. You close your bracket. Now, this is often what plays out. But in rare case, the formula can extend. The formula can extend. Let me show the extension. Most times we don't show the extension because you might not be given the debt beta in the question. And most questions will not give it to you. So where the debt beta is not given, the other part of the formula becomes what? 0. 0 multiplied by everything in that aspect will be 0. So now, but let me show it in full. But most likely we'll be working with just this aspect. Let me show it in full. So you can have it this way, where you have debt beta given in the question, it will be in this form. It will be in this form. And this will be debt. And debt is always what? Enjoying tax savings, 1 minus t. 1 minus t. So you have it. This is the overall formula. But where debt beta is not given, where debt beta is what? Is 0. 0 multiplied by all this will give you what? 0. And that is why we mostly work with the first part of the formula, because what the question will always give you is your equity beta geared. But where the question is giving you the debt beta of the project company, then you substitute, you use this whole formula. But based on this, just take note that this is what we'll be making use of. This formula can be in another way. Let's say or, because some students will solve with another formula. This week, somebody called me, yes. The person was going through the questions in the question and answer kit, and she was using the formula in that question and answer kit, which is the other formula I'm going to show. And she was not getting the answer. She has used this first formula. She was able to get the answer. So she was trying to test with the other one, but she was not getting it. So when she put a call, we look at it. She was not pressing her calculator well. She was mixing up certain things. But definitely, once you use this formula or the other one I'm going to show, you're going to get same result. So the other formula will be in this form. Let me still use this. Equity target. Yes.
Sir, I wanted to, sorry to interrupt. I wanted to snap the full formula before you move to the other one, because I don't have it in my notes, sir, in case I...
This is it. I'm coming. Let me add one more thing. Wait, don't snap yet. Let me include one more thing. I deleted this, so let me include it. So this is the full formula. This is the full one. So in most instances, I said we only use this aspect. So now we can have this, we can determine our asset beta using another formula, or equity beta geared multiplied by what? 1 over 1 plus what? Plus, let me do it this way. Plus 1 minus t multiplied by what? Debt divided by what? Equity. Debt divided by equity. This is another formula. Please take note of this, or so you will not join the two formulas together. So whichever formula you use here, you are going to get same result. Same result. But the point I want to emphasize now is the interpretation of certain statements when it comes to the issue of debt and equity. The interpretation. In some question will tell you that debt equity ratio is 0.4. What is the meaning of this statement? Debt equity ratio is 0.4. What is the meaning? Debt equity ratio is 0.4. Who can interpret?
So let me try it. So it's as if the debt proportion of the capital structure is 40%, while the equity is 60%.
Okay, that is one version. Let me hear from another person. So I will now know.
Let me try.
All right.
I think the debt equity is 40%, while equity beta is 40% plus 60%.
Okay. All right. That is one. Let me hear from another person again. Yes.
Okay, let me try, sir.
All right, ma.
It means the debt value is 40%, while the equity value is 60%.
Okay. That is, you are saying the same thing. I'm not getting the answer.
Let me try, sir. Let me try some.
All
So,
right,
you know,
ma.
you said the par value of debt is 100.
Yes.
So this equation is showing that the project company consists of both equity and debt. So the par value of debt is 100, then the equity ratio is 40%.
Okay. Okay. Let me hear from Madam Victoria.
Yeah, I want to say the same thing. Debt is 40, equity is 100.
Okay.
Let me try, sir.
All right.
It means that debt is 0 and equity is 40.
Okay. Okay.
I think, can I try, sir? Means if we divide debt by equity, we'll have 0.4, that is 40%.
Okay. Okay. This is where the confusion is. Even in SFM class. Some of you solved a question in the SFM Pathfinder last diet. I don't know if Madam Victoria is here. Yes, there was a question she forwarded to me from the SFM. You have similar issues like this. Yes, similar issues like this. Now, this debt equity ratio is 0.4. What it means is that your debt is 40%, your equity is 100. Madam Ruth, I was expecting you to give me the right answer. We've had conversation about this before, right?
Yes, sir.
Yes. So debt equity ratio, when you see it in this form, it means the debt is 40%, the equity is 100%. So if you want to express this in this formula, your equity will be what? 100. Your debt will be what? 40. Now, this is when the question is coming in another way, that the gearing ratio is 0.4. Gearing ratio. What is gearing ratio? What is gearing ratio? So let me just show. Okay, yes. So let me just make this more clearer, please. When you say debt equity ratio is 0.4, the implication of this is that if debt is 40%, equity is 100, right? When you divide this, what will be your result? What will be your result? 40%. That is same as 0.4, right? Please, is this clear?
Yes, sir.
Yes, sir.
So now, if you want to now substitute into this formula, your debt will be what? Will be 40. Your equity will be what? 100. Please take note. That is one area of confusion. They will always come. They will not give you the value of equity expressly. So they can just use it in a ratio form. I think I have a question like that here. Though I didn't treat it during my normal classes, but I know I have it in my slide. Yes, see it here. See it. PPLC has a gearing ratio, debt to equity of what? 0.4. 0.4. And the beta of its shares is 1.8. So if you don't know, you're going to say, okay, debt is 40%, equity is 60%. That is wrong, because they are already telling you gearing ratio. What is the formula for gearing ratio? So that is the expression. So this is one of the main points that they will always come and confuse students. So once it is expressed in this form, quickly take note that what it means is that your debt is 40, your equity is 100. So when you say 40 all over 100, you have what? 0.4. 0.4. So take note of that. Very important. So you can either use this formula to determine what? To determine your asset beta. But where the question have given you your asset beta, you don't need to solve this, but it will be in a very rare situation, because the examiner will want to test your understanding of this process, of this whole process. So they will definitely not give it to you. But where it is given, you don't need this step. But where it is not given, you need to use this formula to determine your asset beta. Just 1 minute, please. All right. So now, this on gear, which company are you on gearing? The proxy, right? Now, once you ungear the proxy company to get the business risk, you don't have anything to do with it again. Take note, you don't have anything to do with the proxy company again. What you need is just their business risk. So what will you do? You pick their business risk and incorporate into your own what? Into your own organization, and see what will be your equity beta geared. So let's move to the next step now. Since you've ungeared the proxy company, what will you now do? The next step will be for you to regear. You are regearing using your own organization data. Please take note, not the proxy company's data again, but your own organization data. I know I'm emphasizing this so that when we solve a question, you see it clearly. So the next step is for you to regear. Regear. You regear. You regear based on what? You regear the asset beta. You regear the asset beta. You regear the asset beta. Calculated in step 2, in step 2 above. In step 2 above. In step 2 above. So when you regear, your formula will be what? When you regear, what would be our formula? How will our formula look like? Now, for you to regear, you can still use this formula to regear. Very well. It's just for you to look for the subject of the formula, but using your own company's information. Your own company's information. So now, for you to regear, we'll have it this way. Equity beta geared. Equity beta geared. Equity beta geared. This is it. Equity beta geared will be equal to, since you have your asset beta from the proxy company, will now be what? Your asset beta. Your asset beta multiplied by what? 1 plus what? Plus your debt divided by what? Your equity. Your debt will always have an association with what? With tax. Let me put it here. 1 minus T. 1 minus the tax rate. Let's put it here. 1 minus the tax rate. So you can use this formula to do what? To regear. You can use this formula to regear. Now, once you regear, what will be the next thing? You can now compute your cost of equity. The essence of you regearing is to get what? Your equity beta. To get your equity beta. Your equity beta of your own organization. Incorporated the business risks of the other company or other industry. So once you regear, you can now calculate what? Step 4. You can calculate what? Your cost of equity. Calculate cost of equity. And for you to calculate cost of equity, you can use what? Your CAPM formula. You can use your CAPM formula. Your CAPM formula. And what is our CAPM formula? Your CAPM formula as shown below. What is the CAPM formula? Your cost of equity equal to what?
RX plus beta
plus beta
into bracket RM minus RF.
Yes, plus beta. That is which beta now? Your equity beta.
Equity beta.
The one you derive in step 3. So multiply by what? Market return minus what? Risk-free. Market return minus risk-free, otherwise known as what? Premium.
Premium.
Now, the step 5 will now be what? Some question will not require you to determine step 5. Some we just want you to stop at step 4, depending. So step 5, calculate
the WACC.
Calculate project specific weighted. Project specific weighted average costs of capital. average cost of capital. And this is termed as what? WACC. 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 So what is the formula for your WACC? WACC is equal to your cost of equity multiplied by what? Multiplied by equity divided by, okay, let me use an appropriate formula. So let's use something like this. So we can have it this way. Cost of equity multiplied by what? Equity divided by what? Equity plus debt. Equity plus debt. And you close your brackets. Close your brackets. Plus your cost of debt. Cost of debt is always what? Net of tax. But in some questions, the tax value might have been eliminated. So you just use the cost of debt directly without these workings. So this is the whole, how the formula should be. And we have it, cost of debt. And you can now have it this way, to be in this form. Cost of debt. See, you're talking about debt. The numerator will be what? Debt. And the denominator will still remain equity plus debt. And you close. And this is how the formula will be. Once you get it, if you are not working based on percentage, your final result should be multiplied by 100 to get it as what? In percentage value. So this is your formula for WACC. This is your formula for WACC. Cost of equity multiplied by equity divided by equity plus debt plus cost of debt net of tax multiplied by debt divided by equity plus debt multiplied by 100 over 1, where you want. Now, why all these stories? Why all this? Once you determine your WACC, the WACC you calculate will then be used to evaluate what? The project for the purpose of NPV. You know, this WACC is a form of cost of capital. You understand? It's a form of cost of capital. So you can use it to determine your NPV. You can use it to determine your internal rate of return. That is the basis of all this. Please, any question regarding this? Let me take questions now. Yes, what is the question?
Okay, sir. I just wanted you to take that last part where you were talking about why the calculation of WACC.
Yes, we calculate WACC for you to know the basis on which to place your cost of capital. By the time you determine your WACC and you use your WACC to compute your NPV and you are getting a positive NPV, it shows that the project you want to invest in is worthwhile. It means your diversification will make sense. But when you now compute your WACC and you use your WACC to determine your NPV and you're not getting negative NPV, it shows that it's not worthwhile to invest in that project. So the WACC calculated can be used to evaluate or discount the cash flows of projects for the purpose of determining what? NPV. And you can also move further to use it basically to determine NPV. Yes. So as a basis to make a decision if it is worthwhile to diversify or not. I don't know if that is clear.
Yes, sir. Thank you, sir.
Let's solve the number one question. This is a question. Question 1. That BICO is a hot air balloon manufacturer whose equity is equity debt ratio. Equity debt ratio. Now, what is the difference between this and the other illustration I displayed? Where is it? The one I talk about that equity debt ratio, equity or debt equity ratio is 0.4. What is the difference between these two now? The difference between that and this.
I feel like the other one is in percentage, right? And no, this one, the ratio has been given. Equity is 5 and debt ratio is 2.
Okay, it is clearly defined.
Yes, sir.
Okay, that is the proportion of equity in the capital structure is 5. Proportion of debt is 2. But where it is just stated that debt equity ratio, it means they are telling you that the gearing ratio is this. Debt equity ratio is 0.4, because this is where the confusion usually comes. People use this concept to apply and work the other one that showed that debt equity ratio of 0.4. So there are two different things. This one is clearly giving that, okay, if my equity to debt ratio is 5:2, it means overall 5 plus 2 will give you what? We give you 7. So my equity will be what? 5 divided by 5 plus 2. By the time we start solving, you see that my debt will be what? 2 divided by what? 5 plus 2. But where it is just given to you as 0.4, 5.0, that's the debt equity ratio is this. It shows that you have to work based on the fact that your debt is 40%, your equity is 100. But these have been clearly given. So you work with what you have here. So the corporate debt, which is assumed to be risk-free, has a gross redemption yield of 11%. Risk-free, the yield is 11%. The beta value of the company's equity is 1.1. The average return on the stock market is 16%. This is the market return now. The corporation tax rate is 30%. The company is considering a waterbed. Which company now is considering waterbed? BICO is considering what? Waterbed. Because the question will not give you, they will not write it clearly for you to understand. It's you that will now ask, which company? BICO is considering a waterbed manufacturing project. So ESCO is a waterbed. Now, what is ESCO? ESCO is what? It's used as what?
Proxy company.
Proxy company.
Fine, proxy company. So ESCO is a waterbed manufacturing company, because BICO wants to start producing waterbed. They need to look for a company producing waterbed. So it has an equity beta of what? 1.59. This equity beta means what? I've explained. It means what?
It consists of both financial and business risk.
Yes, consists of both financial and business risk. It has an equity beta of 1.59 and an equity debt ratio of 2:1. So BICO maintains its existing capital structure. It means BICO will still maintain this capital structure. In some questions, they can tell you that the capital structure will change. But in this case, BICO will still maintain this 5:2 as its capital structure. Now, okay, that BICO maintains its existing capital structure after the implementation of the new project. What will be a suitable risk-adjusted cost of equity to apply to the project? Now, based on the steps we've shown, where are we going to stop? What will be suitable risk-adjusted cost of equity. Where are we going to stop?
WACC.
Based on
We will not do WACC.
Cost of
Capping.
equity.
Cost of
It's cost of equity where
See it.
capping is going to be
Step
applied.
4. Step 4.
Fine. Step 4. Fine. Step 4. Step 4. But you can, as a student, you can decide to solve, maybe as you practice, to go ahead to solve for WACC. But that is where the question wants you to stop. Cost of equity. Cost of equity. So how are we going to solve this now? Solution. Let's see. Solution. Solution. First, we've identified our proxy company. Proxy company is what? The proxy company
ESCO.
is
ESCO.
ESCO. The proxy company is ESCO. ESCO. Fine. The proxy company is a geared one.
Yes.
Is geared. Is having equity
And
equity beta of what?
1.59.
Of 1.59. Now, since it's geared, we don't need the geared aspects. What we need is just the business risk. So what are we going to do? We apply our formula. We ungear. We ungear. We ungear. We ungear. Now, for you to ungear, what will be your formula? I'm going to write it again. For you to ungear, what are we going to do? Our formula will be what?
asset beta.
Asset beta.
So I'm going to write it. I'm not going to do copy and paste so that every one of us will get used to it. So some people are looking at what is all this formula about. So by the time you write it like 5 times, you get used to it. So it will be, we want to get our asset beta, right? So it will be equal
Sorry,
to
can
what?
I ask a question, please?
Yes, you can.
Okay, so I just want to confirm. This proxy company, is he always scared in the question?
No, sometimes the question might tell you that it is not geared. So where it is not geared, that is why I put it this way in the explanation here, that an ungeared, where it is not geared, it means you only have what? Business risk. And step 2 will not be, this step 2 we want to solve for now. You will not solve for it. You just apply it into your own company structure, capital structure. So depending on the question, where it is not geared, you don't need this step 2. But I said the examiner will not want to give you.
Okay, sir.
Yes, they will not want to just allow you go like that. They want to test your understanding of the various steps. So.
Okay, sir. Thank you.
All right, ma'am. So the formula is what? Asset beta. Asset beta will be what?
Equity beta geared
Equity beta geared
into equity
beta geared is equity beta geared into what? Your equity beta. So we have it as this. So these will be what? Equity, and the denominator will be what?
equity plus debt.
Equity plus debt. The debt,
-2.
yes, 1 minus T. So I'm going to solve using this formula. When we are through, we'll go back to the other formula. Every one of you will solve with it. You solve with the other formula, and let's see if we are going to get same results. Same results. Now, based on the question, we have equity beta given, which is this, geared. Which is geared. Now, your equity value in the question for the proxy company is what? Your equity beta geared is 1.59. Isn't it? Now, what is your equity in the capital structure for the proxy company? See it here, equity debt ratio. So your equity is 2 and your debt is 1. So equity is 2. So at this point you have 2. Likewise, your debt is what? Is 1. Your tax rate given in the question is what?
30%.
30%.
So 1 minus tax rate of 30%. So 1 minus 0.3. So when you simplify this, another problem is students find it difficult to apply the rule of BODMAS. Some will just press their calculator anyhow and expect to get the result. It will not work. You must follow the rule of BODMAS. What is BODMAS? First is bracket. That is the B. The O is what? Is off. The D is division. The M is multiplication. The A is addition. And the S is what? Subtraction. So you must follow it in that sequence for you to get your result as expected. So whenever you see anything in brackets, go and deal with that first. Deal with that first, and you'll be able to get the right answer. So now, when you simplify this, 1 minus 0.3 will give you what?
0.7.
0.7.
0.7 multiplied by 1 will give you what?
0.7.
So 0.7
Plus
plus 2.
1.17.
Okay.
2.7.
2.7. So 2 divided by 2.7 will give you what?
Zero point
0.740.
0.740. Multiply by 1.5.
1.18.
So it means that my asset beta, just my business risks, asset beta will be equal to what? 1.18, right? Approximately, right?
Yes, sir.
1.18. Now, having determined your asset beta, what will be the next thing?
You regear.
You regain.
We
You
incorporate it into our own.
Yes, you regear. You regear. You regear. You regear. Now, if you want, hello, if you want,
So I'm not getting the answer.
Madam Macaulay, you say you are not getting the answer.
I'm getting 1.51.
Even me too, that's what I got.
1.51.
Oh, my own is 1.178. So
Approximately is
1.1.
1.8. Yes. So for those of you not getting 1.1777 like that, when you press your calculator, 1 minus 0.7, you have what? 1 minus 0.3, you have what?
0.7.
0.7 multiplied by 1, you have what? 0.7.
Yes, 0.7.
0.7, fine. 0.7 plus 2, you have what?
Okay. Okay,
Madam
I'll
Macaulay, you are not following.
2.7.
2.7.
So 2 divided by 2.7.
Okay. 0.74.
Multiply by 1.59.
Okay. Thank you, sir.
Madam Macaulay, are your children around?
1.18. Sir, no. They are not around, sir.
So follow what we are doing, ma.
Thank you, sir.
Abi, you want to go to work, ma?
Yes, sir.
Okay, sorry. Yes, Madam Kimi, let me hear from you.
Sir, we didn't use the, when we are calculating the assets beta, is it because they didn't specify in the question that there is a debt beta? That's why we didn't use the other part of the formula.
Yes, ma.
Okay, sir.
Yes.
Thank you, sir.
Yes. So, and I said it will be in rare case. It will be in a rare situation where they will give you the debt beta of the proxy company. It's always very rare. But we need to show it so that when you see it, you will know how to apply it. Yes. So, but most times it will just be in this form. But where it is given, you apply the other part of the formula. So now, I want to say something. We can regear still using this formula here. Take notes. But I'll go with the one I've shown already. We can regear using this formula here. What do we need to do? It's just for me to make my BEG subject of the formula. And I might not necessarily do that. It's just for me to say, if BA is 1.18, fine, write 1.18. What is your E of your own company? What is your D of your own company? So when you solve, you discover that you now get the value of equity beta geared of your own company, even without using the other formula. Yes, but you still get same results. But let's go with the formula we've shown, that for you to regear, use this. But you can still use this likewise. Yes, you can use this and you get same results. Same results. So all you need to do, use your own company's information now, not the proxy company's information. Because what you need from the proxy is just the business. So you just substitute here, substitute your own equity value here, your own debt value here, and when you solve, you get the value of BEG, that is equity beta geared in that form. Yes. So, but from the step we've shown, I said you can regear using this, right? You can regear using this. So to regear, it will be what? Using this formula. So we want to get our equity beta geared. Equity beta geared of our own organization. Your own organization is what? BICO, isn't it? BICO. BICO. Take notes, please. BICO. That is your own organization, BICO. Now, to get the equity beta geared of BICO, it will be what? Your value of A, the business fees of your proxy company is what? 1.18. Now, what is your own debt value? Your own debt proportion in your organization? 2. And your equity is what?
5.
Equity is 5. So you have it. So this will be 2, and your equity will be what? 5. So when you solve this, your tax is what? 30%, 0.3. When you simplify this, what will be your equity geared beta? When you simplify this. So let me help. First and foremost, You can say 2 over 5. 2 divided by 5 is what? 2 divided by 5 is what? And you punch your calculator.
0.4.
0.4.
Two divided by 5, 0.4, right? Multiply by 0.7. The 0.7 is 1 minus 0.3. So what will you have? 0.4 multiplied by
0.28.
0.28.
0.28 plus 1 will give you what?
1.28.
1.28 multiplied by 1.18 will give us what?
1.5104.
1.5104. Let me show some of the little workings. Let me show some of the little workings. Ma, what is your question?
Good morning, Sir Tope. I'm looking at that debt ratio. I thought debt, when you see debt ratio, is the implication is that the debt is 5 and the equity is 2.
Yes.
But we use equity to be 5 and debt is 2.
Look at the question.
Yes,
This is the question, ma'am.
the debt ratio is 5:2. So
No.
I thought equity is there. You have seen it. I've seen it.
So now, let's still show one more step so that let's still show one more step here. That is so we can have it this way. So when we see,
Hello, sir. Please, based on the question the last person asked,
yes, sir.
so that this one is very clear. Equity debt ratio is 5:2. Yeah, exactly. But the first one you showed based on 0 point debt equity, it wasn't like that. So you said when it is 0 point or 4 point. So if we do the percentage, equity will be 100. The remaining will be debt.
Yes, sir. Yes, sir. Yes, sir. That is how it works, sir. Yes. What is your question?
Good morning, sir. So, sorry, you said we can use that 1.8 and now change, as in putting the like the main companies, this thing, like the main companies, put the numbers inside the while calculating using the other formula. I tried it, I got 0.92, but using this formula, you got another thing. That's what I was confused.
Yes, you didn't do some things well. That is
Okay,
why. When you settle down and do it, you get it.
Okay, sir.
Yes. And if I still have my time, I can still show you the other side of the formula. When you make your A to be 1.18 and you solve well the other part you should have 0.78 BE. So when you now say 1.18 divided by 0.78, you should have 1.51, which will be your equity beta. So is what I've done before, and I was able to come up with that analysis.
My confusion is the working of the second bracket.
Okay, let's go there, sir.
If you look at this D divided by E,
yes, sir,
there's a bracket associated with that D. But you first of all divided the D by E before
yes, sir,
multiplying. And if you are going by board mass,
this is how it works, sir. You can, you see this 2 over 5. This is 2 over 5, right?
Yes, sir.
So when you break down 2 over 5, what will you have, sir?
0.4.
So this bracket is associated with 2 over 5. What this bracket means is that this bracket multiplied by 2 over 5. So for you to still eliminate the issues of this bracket, it will be what? The 0.4 multiplied by the element in this bracket, which is 0.7. So 0.7 multiplied by 0.4, sir. You clear this aspect off. You
Okay.
clear this aspect. Is that clear, sir?
Yes, sir.
So
Sir,
when you,
I
all
just
right,
wanted to say, I worked it like, I opened the bracket and I divide, and I got the same answer. Like,
yes,
I multiplied 2 multiplied by 0.7 divided by 5 plus 1.
yes, you get that same result too. You get same result. You know, this is mathematics. Many ways lead to market. Yes, but still in following the guidelines. Yes, as a guideline, if you don't follow certain rules, you will still not get it, even though many routes lead to the market. You must follow the principle. So now, 0.7 multiplied by 0.4, I just want to show one more step before I write the final.
Sorry, don't be angry, sir. That 0.78. I see what you're saying. Is it? I will now divide it by the 1.18.
It will be 1.18 divided by 0.78.
Okay, divide, not multiply. Okay, sir.
So now 0.7 multiplied by 0.4 will give us what?
Zero 0.28.
0.28. So 0.28 plus 1 give us what? 1.28. So 1.28 multiplied by 1.18. Your equity beta geared will be what?
1.51.
So equity beta geared equal to 1.5. So this is the third step. So what will be the fourth step now? The question wants us to do what?
Okay.
Cost of equity. Cost of equity. So the next step is to apply your CAPM, isn't it? You apply your CAPM, and this is it. You apply this concept here. You apply this. So from the question, to get your cost of equity, your risk-free is what? What is your RF?
2%.
11%. Your RF is 11%. 11%. 11%. Your RF is 11%. Your equity beta is what? 1.51. And your market return is what?
16%.
16%. The question will not make it like a nursery one thing and say market return is this, verbatim. No. They will just say the average return on the stock. Some question might give it to you directly, but they want you to at least think a little. The average return on the stock market is 16%. So, and the market return is 16%. 16%. And the risk-free is what? 11%. So when you solve, what will be your answer? Your cost of equity will be what?
$18.55.
55.
Okay. Cost of equity 18.55%. So this is your results. This should be your results. You are not getting 18.55. Just raise up your hand. Let's know what is happening.
18.5.
Fine. 18.5. So let's now go to the one they asked us to solve last diet and see what is happening there. I will explain, you will solve. So Niger Gold PLC, a listed company in the bottled water and fruit juice business, is considering investing in the premium coffee shop business by launching a chain of branded outlets in Lagos and Abuja. Because the coffee shop business has different business risk profile from its current operation, management decides to base the project risk on a pure play comparator from the coffee business. You are given comparator company data, coffee sector. So comparator company data. What is the meaning of this comparator company data?
Proxy data.
The proxy data. So you don't expect them to come and write proxy for you. So you should be able to understand by reading, by English language, that this is a proxy information, comparator. You are comparing, you want to compare Niger Gold with the other company. But if the company name is not stated directly, they're just telling you the sector, comparator data. So now, this is the proxy. The equity beta is what? 1.50. The debt to equity ratio is what? This is the gearing ratio, 0.4. 0.4. Corporate tax rate is 30%. Now, project financing plan. That is for Niger Gold now. Their plan is what? Niger Gold will finance the project with debt equity ratio of what? 0.6 market value based.
0.6 market value based.
That is 0.6 market value basis. We have pre-tax cost of debt for the project, 12%. Market data now, risk-free rate, 8%. Market risk premium is what? 6%. I asked a question before now, or I stated that market return minus risk-free will give us what?
Market premium.
Risk premium.
Premium. So this understanding must be with us. It's not everything that will give you one after the other. So the project is expected to have the same business risk as the comparator coffee shop business. The question is now, calculate the asset beta for the coffee shop business using the comparator company's data. This question is so straightforward that they are even telling you what to do at time. They are telling you this is what you have to do, telling you the steps. So based on this information, one, what are we going to do? That's why they're even putting 1.5 mark, 1.5. So what are we going to do?
It means we should get the business risk, right?
We're going to the business of the proxy company.
Proxy, yeah.
So now, the information given, Mr. Friday, I can see your hand. I will call on you soon. I just want to have a flow. So now, from the information given, we have the statement saying that debt equity ratio is 0.4. What is the interpretation of this?
It means that debt is 0.4%, while equity ratio is 100, just like we said earlier.
Yes. So with this information now, help me solve for the business risk of coffee sector. Help me solve business risks. You can use this formula. You can use this formula. So it means your D will be 0.4. Your E will be what?
100.
100. So if you don't want to get confused, you can just say 40 and 100. 40 and 100. You understand? So please quickly solve and give me the value of asset beta. Solve and give us the value of asset beta. The exam have started now. The value of asset beta. So, or you can say 1 and 0.4.
1.171. 1.17.
1.171. 1.171. Yes, let me get a confirmation. You said? Madam Joy.
1.17.
1.17. 1.17. That should be the answer we should all have. 1.17. 1.17. To get the assets, the equity beta given in the question is what? Is 1.50, right? Your equity is what? Is 1. Equity is 1. If this is 1 and this is 0.4, and this is your tax given in the question is what? 0.3. So when you solve this, what will be the outcome? What will be the outcome? I'm expecting the answers. Though they've given me the answer, but still, for those that have not given it to me, solve and tell me what the asset beta will be.
1.17.
1.17 approximately. If you are not getting it, yes, Mr. Friday, let me take your question. Are you there, sir? You are muted. So in case you are speaking.
So there are 2 Fridays there.
Okay. This is Mr. Friday Joseph. Okay. Maybe it's a mistake. Madam Ineka.
Good morning, sir.
Good morning.
Sir, please, I have a question. My question is, why do we use 0.4 for the debt? I thought the equity is supposed to be 0.6 since the debt is 0.4.
Yes. 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 Oh, my network is bad.
Somebody should explain this. Somebody should explain this.
Hello, she
Just
should
meet
come
yourself.
again, sir.
Meet yourself, Ineka. You understand? Your audio is always causing reverberation. So once you speak, anytime you are speaking, I will just keep quiet. Yes. So once you finish giving us or asking your question, just mute yourself. You understand? Or if you have any more concern, you can just put it on the chat box so that it will not be rowdy. Yes, our question is, why are we using 0.4 as the value of our debt? The fact that we're using 0.4 as the value of our debt, we should use 0.6 as equity, isn't it? That is our question. Even though I've explained before, maybe she was not in class then, but somebody will respond to that. Yes. So somebody should respond to that question.
Okay, can I say something?
Yes.
Okay, the debt to equity ratio is just like a gearing ratio, and the formula for gearing ratio is debt over equity plus debt. Then here they already gave us debt to equity ratio as 0.4, which means debt is 0.4. Then the divide by equity plus debt. Equity is equity is 60, while debt is 100. The denominator is 100, while the numerator is 40, which is equity is 100 and debt is 40%. I don't know if I'm able to explain that. That's my own understanding about it.
Mr. Tokwe,
Yes.
let me try.
All right, ma'am.
The way you explain it, excuse me, at the beginning of the class is that when you see it in the question that they are putting equity to debt is maybe like 4 to 5. That is when you are going to use that 4 for equity and debt 5 for in calculation. But by the time you see that debt is 0.4 in the question, that you should just take it that equity is 100%. And if it is debt over equity, it's going to be 4/1. That is that 100%. That is how we should be going about it. I don't know, maybe I'm correct, sir.
Yeah, correct, ma'am.
Yeah, that's correct. That's what I asked earlier. I asked it and you explained it now. That's my, I think, can I say my mistake? The other time, I went and used that even that 0.4, just like that, to do the calculation. But you've emphasized that debt to equity ratio, whenever we see 0 points or 4 points, then we should know that equity is 100% and the other one should be 40% should be debt. But when it is normal figure, like the one we just solved now, based on Bico company, 5:2, you know that the ratio has been given. So you take the figure like that. And we use that 0.4 against 0.6 because we need to do the proxy company first. When we went to on gear, we use the proxy company. Thank you.
If you look at my screen,
Hello, sir.
I can hear you.
All right, sir. What I just want to add to that is whenever we see debt to equity ratio, that is talking about gearing ratio. That is different from when we are giving in ratio debt to that they wrote debt ratio debt and ratio debt to equity is different. But when you see debt to equity, that is talking about gearing ratio. And when you talk about gearing ratio, is debt over equity. That is the answer is now 0.4. If you divide 40 divided by 100, it will give you that answer 0.4. So that means that it is 40 to 100. Debt to equity is 40 to 100.
Yes, thank you very much. So thank you, everyone. So this issue is a very dicey one that even when you go to the next stage of your study in SFM, you always see this coming, causing confusion. But I'm trying to make it very clear now, so that when you get there, you'll be a superstar. You understand? And there will be no any issue to. So once you see 0.4, just as they've said, is gearing ratio. Gearing ratio. And then if you look at what I've put down in writing, that for every 100 naira of equity, there is 40 naira of debt. And debt, the gearing ratio is debt all over equity, which is 40 all over 100. So if you want to get your gearing ratio, which formula is debt all over equity, if 40 is all over 100, your gearing ratio is what? 0.4. So it's, if your debt is 0.4, your equity should be what? 100. So once you are just giving a percentage of one value, that debt is 0.3, it means your debt will be 30, your equity will be 100. Madam Ineka, I'll keep quiet now so that you respond. Is this clear or not?
Thank you, sir. I'm cleared.
All right. So I'm still seeing this hand up. I don't know if it's a male now. This Friday Joseph Inform. I think these are my people from the South.
Yes, sir. Good morning, sir.
Norima, what is your question?
Okay. But please, I'm very, very sorry to. It's not a question. I'm sorry to take you back. Please, can you go to question 1, step 3, where we calculated reject? I want to screenshot it. I'm sorry. I want to screenshot the solution. Yes. Okay.
Madam
Yeah.
Mary, can you speak?
Yes. Thank you. Thank you so
Madam
much.
Mary.
Oh, yes, sir. So I want to confirm from the first question, they gave us equity 2 to 1 for deposit company. But for this one, we just use 1 for the equity part. Is it that we are assuming that equity is always 100%, except otherwise stated in the question?
Yes, it was not for far-fetched from what we just responded to. You know, in this second question, they are just giving us the gearing ratio. The gearing ratio are 0.4. In the first question, the case is different. The first question, you can see equity ratio debt, equity debt ratio. So in this case, it means your equity is what? 5, your debt is what? 2. In this second question, the question is just saying that what? Your debt to equity ratio. Debt to equity ratio. This is, they are not giving you 5:2 now. They're just saying debt to equity ratio 0.4, which means this is a gearing ratio. So if debt to equity ratio is 0.4, automatically your equity is 100%. Equity is 100%. So if your equity is 100%, your debt is 40%. That is the interpretation of this. So based on this solution, I can decide to use 100, to put 100 in place of 1. So in place of 0.4, I can decide to put what? 40 and still get same result. So whenever you see the statement in this format, 0.4 without any other associated value, maybe 0.4 ratio this, it means that your debt is 0.4, your equity is 1 or 100, whichever one you choose to use. If you are using 100, it means if you are solving, 0.4 will be what? 40%. You write 40. If you are using 100, if you are using 0.4, instead of using 100, you will use 1. I don't know if that is clear, man.
Sammy, I'm still getting.
Yes, sir. Very, very clear. Thank you.
Hello, sir.
I can hear you.
Hey, what of if the case is reversed now? Assuming we are giving the value of equity, how do we determine the value of debt? Because I'm
It will
just
still be
looking
same.
at it from that perspective.
Yes, it will still be the same concept. If you are giving the value of equity, where they're telling you that equity is this, it means that debt will be 100%. You get me?
Okay, sir.
Where you are not
Thank you,
giving
sir.
one unknown, when you are not giving one unknown, and you are giving one to be known, the other unknown will be 1.
All right, sir. Thank you, sir.
So that is for the A part. You have the asset beta to be what? 1.17. The B part of the question is telling us what? Reliever the asset beta to reflect the project's capital structure. Another word for reliever is what?
Regear.
Regear.
Regear. So now, can you help me regear now?
Yes, sir.
1.66.
1.66. Okay. So for us to regear, you can either use this. Let's see. Everybody solve. Don't wait for my own solution. We've already analyzed before now. So don't wait for my solution. Reliever. So you have A to be the value of A as computed to be what? 1.17. Then this should be 0.3. And this, your debt, is 0.4. This will be 1. So when you simplify, your result will be what?
Sir, I think we are sorry, sir. I think we are regearing using the companies.
Yes,
We are
yes.
regearing to the
Yes.
Project
Using the
finance.
0.6.
Yes. So now
0.6.
this value here will be 0.6, right?
Yes, sir.
Yes.
So now, when you solve now, the outcome will be what?
1.66.
So 1.66. So this is what most people used to shout. This thing is very difficult. Especially why it's only SFN.
So are we not considering our pre-tax?
This is it, sir. The tax rate in the question is what?
But the pre-tax in our company now. The
Pre-tax cost of debt.
That one is the cost of debt now.
Pre-tax cost of that is the cost of debt, the KD. That is the cost of debt. That one will be used when we want to determine our WACC. That one is will be used when we want to determine our WACC value. That is the cost of debt. That is cost of debt. The cost of you borrowing money. We are yet to. We will not use that now. It's not part of what we need. Based on this question 2, it's not part of what we need now. Yeah. So now, please, everyone in this class, do you have this figure 1.66? Okay.
I just got my
1.66.
So I got 1.79. Is it correct? Okay, is it 1 minus 0.3, not 1 minus 0.12? The
tax rate given in the question is corporate tax rate 30%. 1 minus 0.3 is 30%. Please, let's always follow what we are doing part time. Yes. So now the next question is what? Calculate the project cost of equity using CAPM. Since you've determined your equity beta, you can now solve for CAPM. Now, what is your CAPM formula? Your CAPM formula. This is it. CAPM formula. we have it as what? The question is asking us to do what? Calculate the project cost of equity using CAPM. So cost of equity. Cost of equity using CAPM. CAPM is what? Capital asset pricing model. So this is the formula. Now, from the question, your risk-free is what? From the question.
8%.
8%. 8%. Risk-free is 8%. Risk-free, 8%. Risk-free is 8%. Now, your equity beta is what?
1.66.
1.66.
1.66. Your market return is what? The question. 6%. 6%. Market return is 6%. And your risk-free is what? It's 8%. So once you simplify this, you are going to have your cost of equity to be what?
I got 70.9.
Yes, sir.
18.
Sorry, Mr. Atope. Atope.
The
I thought
market
you were
return
giving
is
fixed premium already.
Premium.
The risk premium.
Premium.
Yes.
That's premium.
All right, fine.
We'll use the premium.
Okay, that
Premium.
is fine. So the premium is what?
6%.
6%.
Just
Fine.
Or can we do
6%.
14 minus 8?
So 6% is market return minus RF is already given free of charge. So once you simplify, the result will be what?
17.96.
17.96.
17.96%. So this is what they asked you to solve last night, too. Free of charge.
oh, wow.
Now, wow. When I saw this question,
You were telling me that it was,
my mind,
it was
what
hard.
you don't know, it is well.
Something that you don't know is bigger than
Sincerely,
you.
what you don't know is thank God, I understand it now.
Okay, thank
the
you.
So the next
Thank
step
you,
is
sir.
calculate the project WACC. Calculate the project WACC. So now, what is our formula for WACC? The formula for WACC. This is our formula. This is our formula for WACC. This is our formula.
Hello, sir. Hello, sir.
Yes. Yes.
Please, why using the premium against the risk, market risks?
Yes, ma'am. Okay, why are we using it?
Yes, the premium.
I know.
It is my explanation earlier on that make them to quickly correct me. I said premium is what? Is market return minus risk-free.
Okay.
In most questions, they will give you premium free of charge without you solving for it. So in this question, they've given it to us.
Okay.
So instead of me saying MR minus RF, these have been taken care of. You understand?
Yes,
In the
sir.
question, free of charge. You understand? So now, to solve for WACC, the formula is what? To solve for WACC, the formula will be what?
KE into E
So
divided by E plus D.
your KE is what?
17.96.
Yes, that is the CAPM value you have, 17.96. Your equity is what?
100.
Also go Biko. So now we have it. If your equity is 100, your overall market value 100, your debt is what?
40.
Debt is 60.
60.
Now, your cost of debt net of tax is what? Cost of debt net of tax. Do we have any information?
8.4. 8.4.
Okay, 8.4. Let's go to the question so that everybody will see it. Yes. That's project financing plan. Pre-tax cost of debt of the projects. Pre-tax cost of debt of the project. Mr. Friday, you said 8.4?
Yes, sir. I think there will be tax 30% on it.
Okay, this is pre-tax. So tax have
Yes,
not
sir.
been deducted. If it is
Yes, sir.
post-tax, then you use this value directly. So the pre-tax value.
12%.
So your cost of debt is what? 12.
12.
Then net of tax will give you what? The tax value is what?
30%, 0.3.
So now your debt value here will now be what? 60.
60.
Your equity will be what? 100.
100
plus
plus
what?
60. 60.
Let me locate the person that is making noise. So now, looking at this solution, can you simplify? Let's take it out.
14.38.
How do you do it before you just get to answer? Now, I take it. How do you calculate it now? Take it easy. Let's get this one after the other.
So now, when you work on this bracket here, this region here, when you say 100 plus 60 will give you what? 160. So 100 divided by 160 will give you what?
0.375.
You multiply by 17.96.
100 divided by 160 is 0.625.
Okay, no, that one. On the other side of the go. Sorry, sir.
So multiply by 17.96, man, will give us what?
11.225.
11.225. So in this case now, let's treat this first. 60 divided by 160 will give us what?
0.375.
Multiply by, just keep that 0.375 one place. 1 minus 0.3 will give us what? 0.7.
7.
0.7 multiplied by 12 will give us what?
8.4.
So 8.4 multiplied by 0.375 will give us what?
3.15.
Please, the person that is making noise should just help mute herself.
My Madam Friday.
Let me locate her.
It's Azan. I'll be Azana.
No worry, I've muted her. All right. So now when you do this, what will be when you do this? Let me remove this because we're already working based on. When you do this, what will be your outcome when you add these two together?
14.38.
14.38%. Who is not getting this? Or who is confused? Let me don't assume everybody is on this page.
I'm the one, sir.
Me.
Looks so confusing. Seriously. You know, some of us, this is the first attempt. Please, I know that you have been taking this with us, because if you it's the other way around that we can make it be easier or simple more than this, I really appreciate.
Okay, let me attend to Mr. Shaibu. Mr. Shaibu, have you been in this class since? You know, if you've been in my class, I would have heard your voice. You know.
Yes, sir. I've been in this class since, just that I'll be watching. Seriously, I'll be watching. You know, calculation is my challenge. So I'll be watching since. That's why I did not say anything.
You've been watching keenly. Are you watching keenly, or you are watching and doing something else?
No, full course. Even since I never brushed safe. To let you know that I'm serious.
I thought I was the only one, but
okay, I have customer.
No, seriously, I've been watching and even solving it, but I'm just solving and getting the answers, but I really am not following. Like, I don't understand.
Okay, that is very beautiful. So, Mr. Shaibu, let me come back to you before I go to my sister Joy. So, Mr. Shaibu, can you tell me at what point are you not clear?
Sir, seriously, at the first question, sir, first solution that you solve about the prospect company.
Very good. Yes, you know, you and Madam Joy, I'll create a special class for you. Let me finish what I'm doing.
Okay, sir. Thank you.
I don't want the video to be too long. Let's finish what
they will pay for the class.
They will pay.
No problem. No problem.
So because I don't want to deviate from what I'm doing and go back again. Does not make sense. So it's better I create another section for you. Yes. And at least as I'm going like a snail, moving like a snail, you tell me what is the problem. Then we'll use Holy Ghost fire and quench and kill anything that is the problem there. So that is very key. But for now, let's move. Yes, let's move. So aside these, my two people, though there might be some other persons who they are not speaking. Aside this set of persons, I believe we are getting 14.38%, right?
No.
They are not getting 14.38%.
Yes, those are my hands up. I'm saying that this particular one we solved. I don't know where I missed it, but I'm not getting 14.38%.
Okay, ma. So, Madam Vivian, let's pick it. 100 divided by 160 will give you what? 100 divided by 160
That's
will give you
0.625.
Multiply by 17.96 will give you what?
Yeah, I got that one. 17.96.
Fine.
Yes.
1 minus 0.3 will give you what?
That should be around 0.7. So yeah.
Multiply by 12 to give you what?
7 multiplied by 12. Okay, that's where I missed it. 8.4.
Okay. Then you now solve this bracket, multiply that value of 8.4 by the value in this bracket, and you should have 3.15.
Yes, that's why I've seen where I missed it. Thank you.
All right. Thank you.
Sir, I have a question.
So I got 14.38, but without the times 100.
Yes, you don't need to multiply by 100 again. We're already using we're already working in decimal. You
Okay.
understand?
Yes, sir.
So let me remove this, please.
Excuse, sir. Hello, sir.
I can hear you.
Sir, I want to know the difference between the pre-tax and post-tax. I didn't get you when you explained it.
Pre-tax means tax have not been deducted from the debt. While post-tax means the element of tax has already been deducted from the cost of debt. So where the question is telling you the cost of debt is post-tax, you will not need these workings again. You will not need to show, where is it? You will not need to show 1 minus 0.3 again. You just use the post-tax value directly. Do you understand? But where it is pre-tax, then these will come up. But when it is post-tax, it means they've already solved this for you. So just use the post-tax value and multiply by this. But where it is pre-tax, it means the debt value here has the element of tax. So remove that tax value, and that is the difference. Is that clear,
Thank you,
please?
sir. Yes, sir.
So now, what is the next question? Calculate the project work. We've computed that. Identify and discuss.
Hello, sir. Good morning, sir. Sir, please. Hello, sir.
I can hear you.
Yes, sir. Sir, please. I'm sorry for taking us back. I'm lost somewhere. The calculation of under the calculation of work, I'm still trying to figure out how we got 17.96 as our cost of equity.
See it, ma'am.
17.96. Yes,
This is
sir.
your capital. This is your capital. This is your cost of equity. You just lift it directly. Do you get, ma'am?
Yes, sir. 17.96.
Is this
Okay,
clear?
sir. Okay, I got it wrong. It's clear. I got a wrong figure. That's why mine is 18.55. I'll check to it again, sir. Thank you, sir.
So I will conclude the class now because this theory story, I'm not a theory person. Though I will write it too, but I believe anything story, you shouldn't fail it in the exams. So identify and discuss 4 reasons why the coffee shop business asset beta might differ from Niger Gold's existing bottled water and fruit juice business. So for you to answer this question, you must know what asset beta is. And we've defined asset beta, right, as business risk. So that's what are the reasons that the coffee shop business asset beta might differ from Niger Gold? So what are the possible reasons why the business risk in coffee sector might differ from the business risk in Niger Gold PLC? So can you think and let's just discuss?
Because their capital structure is different.
Yes, that is their capital structure differs. So
And they are exposed to different business risk. Their business risks are not the same.
yes,
They are
the
made
question
of different.
identifies that their business risks are not the same. So they are not saying what are the reasons. You understand? Identify and discuss the reasons. So that is why they are telling you that asset beta, they know asset beta is business risk. So what are those things? Can it be their demand, the demand for the coffee, the demand for Niger Gold products? You understand? So I will just quickly itemize some. One is demand volatility. Demand volatility. Now, Who are those that like coffee? Coffee most times can be seen as a luxury product. Yes, coffee can be seen as a luxury product. So it is discretionary. It depends on you. You might not want to, but do you think bottled water is a luxury product? It's a necessity. Do you understand? Niger Gold is producing bottled water. So it means Niger Gold will have a more stable demand compared to coffee. So bottled water is a necessity. Yes, it's a necessity. You need water. You need water every time. But coffee, you have other substitutes. Yes, and is based on your decision to take coffee or not. But you cannot do without water. So one thing with the coffee will be associated with what? Higher business risk. Yeah, so their beta will be high. And in terms of revenue, you will discover that coffee's revenue will always fluctuate because their sales might be seasonal. And it might depend on the lifestyle of the people in that particular location. Yes. And but water, the revenue of water is likely to be consistent because we need water daily. So in that regard, and you can look at the issue of competitiveness. In coffee markets, especially in certain locations, can be competitive. But in terms of bottled water is what you can see everywhere, and the market is available in almost every location. So you can use these factors to buttress your points. You can go through the study pack and see what they put there. I don't have the. Let me see if I can access the solution in the study pack. Okay. Yes. In the study pack, they are saying reasons why coffee shop sector asset beta might differ from the bottled water. 1, cyclicality of demand, operating leverage, input cost exposure, customer behavior, and brand sensitivity. Yes, so these are just stories. You can read from the study pack and see what they want you to know about that. So the other part is the B. Identify and discuss 5 challenges associated with the use of proxy companies in determining the beta of a new project. In this case, you can use a wrong proxy. There can be an imperfect business match. Yes, the proxy you are using might not be perfect for your own business. So that can be one of the challenges of trying to adopt a model. And different financial structures, different capital structure. Yes, and the company you are using as a proxy might not be a perfect match for your own. The market condition might be different. And what is the data reliability of the information of you are using, of the information of the proxy? The proxy company might not be giving you a real data in their financial statements. They can withdraw their data. And because they are making it out to the public, you using it, the data can be misleading. So data reliability issue is a factor that can constitute a challenge using a proxy company. And the operational differences, size and operational differences. Yes, you are trying to use Dangote as a proxy to an organization that is just 3 years old. You see, there is no match. The comparison will not be okay. So size and operational differences, all these are issues that is associated with using proxy companies' data. So you can read more from the Pathfinder, and you get more knowledge about these theoretical parts. So that is that about these questions. You can access more if you have the compiled past questions I've put forth. There are other questions from there. The first question we treated is from that compiled past question there. So you can go back to it and solve more questions on this topic. So thank you very much. I'll communicate.
Hello,
the next.
sir.
It's,
Please let me ask.
yes, what is your
Please,
question?
we've been tweeting about equity beta. If you not send us question on debt beta, so that in case they ask us question on debt beta, so that we know how to solve it. It's not a question. I'm just requesting for you to send us question on debt
This
beta.
is
Let's
it.
use the formula.
If you follow the class on a normal day, I think there is a question on the issue of debt beta. Let me see if I can locate it. There is a question on the issue of debt beta. Let me see. Can locate it. There's a question on the issue of debt beta. So I'll check for it and forward and forward. It's just for you to substitute where there is a debt beta, put just specific cost of capital. The beta value of the company's equity is 1.1. The average return on market, the corporation tax, the company is considering water-based manufacturing. Oil is a water-based manufacturing. It has an equity beta of 1.59, and the equity debt ratio maintains the existing capital structure. Okay. So I'll check for one and forward. Yes. Check for one. And I think we solved one last diet. So notwithstanding, I'll check. Just remind me, in case you didn't hear from me. Yes. So thank you very much.
Thank you.
Thank you so much.
Thank you, sir.
Thank you, sir.
So Shaibu and Joy, I will send another link.
Thank you, sir.
Shaibu and Joy, I'll send another link. So quickly run through again. Yes.
All right.
Okay, sir.